This is Currency FX GLE, and we are going to talk about how to interpret a mean reversion time series. First, we have to consider that during a mean reversion process, we are going to have two boundaries. One is going to be the positive and the negative sides, and they describe how far the price deviates from the mean value. For example, on the logarithmic scale, where you only have positive values and you can have an increase of variance, you can have growth, a predominant growth on one side that is going to make disproportional deviations from the mean value. So, for example, in this, you can have an 80% deviation, and on the negative side, you will have a 20% deviation. So, you have to consider that mean reversion processes can follow this increase of variance. They can follow these trending conditions on one side, and at last we are going to have the conditions that don't create higher highs or lower highs and maintain on this kind of range condition. So the difference between these two types of behavior is that in this case, we are creating constantly new highs. So we are predominantly moving in one side. And on the range condition, we are not going to have any increases. We are going to respect the boundaries, and we are going to have a kind of a normal distribution. Now, going into the econometric backtest, we're going to look at these two columns over here. This is the autocorrelation and the partial correlation. We are analyzing the USABIX, which incorporates the volatility index for the 30 days ahead, and we are on the other variable, we have the US index, the Dow Jones, which has the 30 largest companies of the stock market in the US. So the autocorrelation is measuring the autoregression. How far does it take for price to push back to the mean value? In this case, for example, you can see that you have a larger distance to achieve this mean value on the index. So until period number 12, you were able to achieve the zero or mean value. And on this case, it was on time on day number 4 that you achieved the mean value. I want to say that the autocorrelation is measuring how far we pull back to the center. If you see the residual plot over here, this is the residual graph, you can see that much of the data is in between these ranges. So supposing this is the lower bound and this is the higher bound, much of the data is going to be in between those numbers. But on the Dow Jones, we don't have the same scenario because we do have much of the data that achieves the extremes on both sides. So that is why it takes a longer period of time to achieve this zero value. And on a mean reversion, we are also looking at the kurtosis. If we contrast the values of the kurtosis, we have a 7-point kurtosis on the VIX and a 1.5 kurtosis on the Dow Jones. We have to know that a higher kurtosis involves a higher concentration of data towards the center. That is basically the kurtosis. So if we remember the curves, a kurtosis is going to look like this, where you have a strong concentration towards the center, and normal distribution will be more smoothed, where you do have a concentration in the center, but you also have these tails that have around 10% of the data. And in this case, you have a minimum of data points on the tails. So in this case, looking at the mean reversion, it took 4 days for the USABIX to pull back to the centric value. We are going to prove that on the chart. If we take a look at the latest increase that we perceived last week, it was this strong candle. It took around 4 days to get back to the origin of that point. So if you can see, these four candles on the downside completely reverse this increase of variation on a daily basis. And on the Dow Jones, we do have a similar behavior, where we have the monthly open at the extremes of this distribution from the highest point and lower point of the prior month, and we have this median. So the median was tested on the second day, and right here the median was tested on the second day as well. So after having an increase of variation, this is the increase of variation that we have on the Dow Jones. We have a pullback to the mean value. In this case, is the median, and in this autocorrelation, we can see that on the data, the graph shows that it will pull back to the median on the fourth day, and on the Dow Jones, it takes 3 times more until period number 12. So what does this involve? As I mentioned, you will have a higher kurtosis on the USABIX because it is constantly retracing towards the center. And the Dow Jones is a more smoothed behavior. Also, on this partial correlation, we are measuring the effects of each day. So we are going to identify seasonality effect every Monday, every closing Friday. What kind of behavior do we have? So the partial correlation works as stational. It is stational because it takes in consideration every Monday, and you're going to measure the distance or the behavior of every Monday. And on the autocorrelation, you are just looking at the data backwards on a regression mode. So this partial correlation, you can see that on the USABIX that we have a more concentration towards the center. We don't have a significance on this partial correlation. So this is behaving more random. It doesn't follow a seasonality effect. And the signal can be on a Monday, on a Tuesday, or on a closing Friday. So you don't have any strong conviction of a seasonality effect or a stationality effect on one day of the week. And the difference is that, for example, on the Dow Jones, you will have some days that are important. For example, these ones over here, which is number 5, number 10. So you can spec a little bit on number 20. So you can start to analyze if we're having these, for example, if we do have a relationship on every 5 days, it will be that we're having a strong Friday closing prices. So it will be a time series that it should be important to look at the closing price, because you're having this partial correlation that every 5 days you can achieve a deviation above normal. In this case, both it is hard to determine a partial correlation on random time series as it is for indices or stock prices. But I just want you to see that in this case, you do have larger deviations from the center on different time periods. And on this case, you basically have a concentration towards the center. That is because you don't have any predominant direction. As you see, every increase will pull back to the mean value on day number 4, or it will take 4 days maximum to pull back to the mean value. And in this case, it takes 12 days. Also, when you have this high volatility or high mean reversion process, you can also perceive a higher skewness, and the skewness will be concentration towards one side of the curve. And for example, on the Dow Jones, you do have proportional distributions around the curve. So right here, over here, and this one over here. And in this case, you basically have a concentration on one range of prices. If we take a look at the USA VIX, and we're trying to see this concentration, we can see that basically much of the closes are in this zone of prices. The data that I have plugged in is from the past 2 months and this present advancement of February. But for example, much of the data is concentrated in this range of prices, as we can confirm on the data. And basically what it's saying is that this increase, it will take for the price 4 days to pull back to the mean value. And that is what happened there. Also having the effect of the kurtosis, which is a strong concentration towards the center. Every time you have a deviation, that surpasses this range over here, which is the higher concentration of values, we're going to say that we have 80% of the values in that curve. Every time you pull back or deviate far away from that value, you will have this kurtosis effect that is saying the data should be concentrated towards the mean. And how far does it take for the data to pull back to the mean value? Well, we can confirm over here that it takes 4 days for the data to pull back to the mean value. But for example, when you don't have this high kurtosis effect, we are going to see this reversion. But on the Dow Jones, for example, where we do take a longer period of time to achieve this mean value, the skew of the curve can be distributed normally. So you can have 50% of the data on this side of the curve and the other 50% of the data on the other side. So you don't have any strong forces that will push price to the mean value, and rather you have this more of a trending behavior on one side or the other, but you pull to the center on a longer period of time. That is the main difference. So personally, for trading purposes, if you're looking at mean reversion, you have to consider the time that it takes for price to pull back to that value. So for example, in this case, which is the recent example that I have for mean reversion strategy, is that during this push on the upside, you already know that the last week of January, we're perceiving an increase above normal or the standard conduct. So once you have an increase that surpasses the normal behavior, then you can start to use or analyze this autocorrelation effect that the time series will follow. The autocorrelation is saying that we are going to push back on 4 days to the mean value. And yes, in this case, at the February open, which is this candle over here, since this opening on February, we have 6 consecutive closes on the negative side. And these closes are following a mean reversion process because we have these 6 closes after having 1 day of increasing variation. So 1 day against 6 closes on the negative side. This is a mean reversion process illustrated on price action. You will have a daily variation that surpasses the normal, and you will have a time period for a moving average to happen. So basically that was all for this video. Thank you for watching Currency FX GLE.